Welcome to The Explainer. Today, we're unpacking an absolute wild ride of a story. We are diving into how a super niche cryptography experiment transformed into a trillion-dollar decentralized asset. We'll be walking through the history, the evolution, and the massive global impact of the Bitcoin standard. So let's jump right in. Think about this for a second. Who invents a trillion-dollar asset and then literally just walks away? It sounds like a Hollywood thriller, right? But that is the actual origin story of the Bitcoin network. The creator, who we only know under the pseudonym Satoshi Nakamoto, published the foundational white paper back in 2008 and coded the very first implementation. But right after the network became self-sustaining, Satoshi just vanished. And this anonymity wasn't just some eccentric quirk. It was actually a crucial defense mechanism. If a known identifiable individual had claimed ownership, early government pressure could have easily shut the whole project down. Instead, it was allowed to grow way beyond any single point of failure. Satoshi left behind billions of dollars in untouched wallets, basically proving that making a profound historical impact was way more valuable than personal wealth. Section 1. The Mystery of Satoshi, the Unknown Creator. Okay, so Bitcoin didn't just appear out of thin air. Long before 2008, privacy activists known as cypherpunks were wrestling with this massive puzzle. How do you create digital cash that perfectly replicates the physical scarcity of gold? Throughout the 1980s and 90s, we saw these amazing cryptographic stepping stones, things like David Chaum's eCash, Wei Dai's B-Money, and Nick Szabo's BitGold. We also saw breakthroughs in linked timestamping and Adam Back's invention of proof of work. But there was always this one huge hurdle. None of them could fully solve the double spending problem, which is exactly what it sounds like, the risk of spending the same digital money twice, without relying on some central coordinator. Satoshi Nakamoto's true genius in 2008 was taking these existing threads of research and combining them with a decentralized proof-of-work system to finally, once and for all, solve that problem. Section 2. From Code to Real Commerce. First, transactions. In the very early days of the network, it was literally just a handful of cryptography enthusiasts testing out the tech from their home computers. The mining rewards they were earning? Completely worthless. Bitcoin hadn't actually been exchanged for anything physical yet. In January 2009, the very first test transaction happened between Satoshi and the cryptographer halving. But the real game changer happened on May 22, 2010. That's when the first known commercial transaction took place, and honestly, the details of it are legendary. 10,000. That massive number represents the exact amount of Bitcoins handed over on that day in May 2010 for, wait for it, 2 Papa John's pizzas. Yep. At the time, 10,000 Bitcoins were worth roughly $41 total. Today, this event is celebrated every single year as Bitcoin Pizza Day. It totally anchors this staggering historical value shift we've witnessed since then. It gave Bitcoin its very first exchange rate of less than half a cent per coin, completely proving that this digital code could actually represent real-world purchasing power. Section 3. Evolution and the halving cycle. Bitcoin's code. Now, central to Bitcoin's entire value proposition is this concept called the halving. It's an automatic condition baked right into the protocol's code. Basically, about every 4 years, the amount of new Bitcoin that miners earn gets cut completely in half. See, Bitcoin has a hard supply limit of exactly 21 million coins, and this halving mechanism ensures that the supply stays strictly disinflationary and perfectly predictable. Historically speaking, these halvings tend to precede periods of major price action, simply because the flood of new Bitcoins entering the market is suddenly mathematically reduced. Because this is open source software, it evolves. And with evolution comes disagreements on technical direction. So we really need to clarify the difference between updates and forks. Protocol updates, like SegWit back in 2017 and Taproot in 2021, are all about improving scalability and core functionality, without altering Bitcoin's fundamental usefulness as money. On the flip side, we have forks. Take the contentious 2017 block size war that resulted in Bitcoin Cash. A fork actually creates an entirely separate, completely incompatible network. Supporters tend to view these forks as healthy, decentralized debate and action, while critics argue they just cause a lot of brand confusion. But the key takeaway here is that the core Bitcoin network just continues humming along on its own path. Section 4. Overcoming roadblocks and volatility. Look, the hero's journey is never without some major hurdles, and the network has absolutely been tested by severe external pressures. First off, high-profile exchange hacks really damaged early trust, though we absolutely have to clarify here. Those breaches stemmed from weak safeguards at centralized exchanges, not from any structural flaws in Bitcoin's core protocol itself. Second, there's been immense regulatory pressure globally around tax, trade, and classification. You've got governments actively grappling with a monetary system that exists entirely outside their control. And finally, extreme short-term price volatility has often spooked new people entering the market. Yet, despite these massive roadblocks, the core network has literally never stopped operating. Section 5. The Institutional Adoption Era. Mainstream Adoption. Bitcoin is money. Everything else is credit. This modernized phrasing, inspired by J.P. Morgan, sharply differentiates Bitcoin from the rest of the broader crypto space. Following Bitcoin's breakthrough, we saw millions of digital tokens and DeFi protocols emerge, usually labeled altcoins. And while they might share some underlying tech traits, the source material notes that these altcoins are much better understood as specialized business ventures rather than forms of decentralized money. Bitcoin truly stands entirely apart as a unique digital commodity. And clearly, the institutions agree. 3.09 million. That is the massive number of Bitcoins currently held by 169 institutional entities as of the source's writing. To put that into perspective, it vividly illustrates the massive shift from a fringe retail experiment into a mainstream institutional hedge against currency risk. Financial giants are now offering Bitcoin ETFs, piping it directly into traditional brokerage accounts and pension funds. Major companies are holding it on their corporate treasuries. The landscape has fundamentally and permanently changed. Section 6. Moving toward a Bitcoin standard global economy. I want you to consider this really brilliant sponge metaphor. Every single time central banks expand the supply of their fiat currencies, a portion of that excess liquidity gets converted into Bitcoin. Because Bitcoin is the only asset in existence whose supply is perfectly fixed and literally cannot respond to changes in demand, its price and its purchasing power is the only parameter that can actually change. So as more people join the network, it acts just like a giant sponge, absorbing all that excess global liquidity. So what does this all mean on a macro scale? We are essentially watching global game theory play out in real time. El Salvador took the path of deep economic integration, making it a core foundational part of their financial system. Meanwhile, the United States is actively moving toward establishing a strategic Bitcoin reserve. Because the network is completely decentralized and politically neutral, it is inherently de-risked from any one nation's hegemonic influence. That makes it uniquely positioned to be held safely in reserve by competing nations across the globe. So how does a technology like this scale to handle 1 billion users before the decade is out? Well, here's the technological roadmap. Step 1 is simply maintaining that perfectly secure, decentralized global settlement base layer. That base layer handles the finality and the absolute security of the massive transactions. Step 2 relies on utilizing Layer 2 solutions, things like the Lightning Network, which are built directly on top of the base protocol to handle immense, rapid volume. And then Step 3 is where those innovations actually enable the fast, low-fee, day-to-day commercial payments that widespread global adoption requires. It effectively separates the deep, impenetrable security of the base layer from the lightning-fast speed needed for everyday commerce. And that brings us to our final, incredibly profound question for today. Are we witnessing the birth of the global Bitcoin standard? An idea of digital scarcity that was once thought completely mathematically impossible went from a $0 passion project to a $1 trillion asset in under 2 decades. It's an unbelievable testament to how technology can empower individuals against seemingly insurmountable odds. Today, researchers really believe we might be inching toward a world where this politically neutral, decentralized network serves as the foundational settlement layer for the entire global economy. It is a fascinating evolution, and understanding these mechanics is absolutely crucial for navigating the 21st century economy. Thank you so much for joining me on this journey through the explainer today, and I really hope this leaves you eager to dig in and learn even more.